In just a matter of days, Bitcoin has erased all of its gains in 2026, while gold just keeps climbing, now pushing toward the $5,000 an ounce milestone. And while markets are digesting that divergence, at the World Economic Forum in Davos, central bankers openly laughed at the idea that Bitcoin could ever compete with fiat money. But an unlikely Bitcoin defender stepped in and calmly dismantled the argument from first principles. Today, we're going to look at why investors seem frozen in wait-and-see mode, why so many are still bracing for a massive end-of-cycle drawdown, and why there's a growing case that Bitcoin may have already lived through its bear market. Plus, we're going to talk about what could finally lift Bitcoin out of this long consolidation and into its first true parabolic run in 5 years, and why that move may end up being larger than anything we've seen before. Welcome to No Second Best, the show where conviction meets reality and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. Let's start with the obvious. This week hurt sentiment a lot. Not only did we erase all of the 2026 gains within days, but gold's continued dominance over Bitcoin has made it especially uncomfortable. Not just because gold is going up, but because Bitcoin hasn't responded the way many expected it to during moments of global stress. And that brings us to something that's been increasingly obvious to me. I think it's becoming impossible to ignore that not only is Bitcoin in a bear market now, but it has been for most of 2025. Now that might sound crazy, especially considering we just hit an all-time high of 126K 3 months ago. But hear me out for a second. The only way you really see it clearly is when you stop pricing Bitcoin in dollars and start pricing it in gold. When you do that, the picture changes completely. Bitcoin is down more than 50% over the last year when priced in gold. That's a clear signal. It tells us that Bitcoin has been losing purchasing power against the world's oldest store of value during a period of geopolitical stress, monetary uncertainty, and rising skepticism towards the dollar system. Now here's where this gets interesting. Bitcoin and gold appear almost completely uncorrelated right now. And you can see it play out in real time. When new tariff threats were floated early this week, gold surged and Bitcoin sold off. But when tensions eased and those tariffs appeared avoidable, gold pulled back and Bitcoin caught a bid. So what if markets are currently treating Bitcoin and gold as proxies for competing global power centers? Bitcoin, at least for now, is being mentally flagged as a US-linked asset. It represents the dollar system, US capital markets, US innovation, and US financial infrastructure. Gold, on the other hand, is increasingly being associated with a non-US alternative. A neutral asset, yes, but one that aligns more closely with China, the BRICS nations, and a world trying to reduce reliance on the dollar. So when investors punish the US, Bitcoin gets punished with it. And when investors look for an alternative to US dominance, gold benefits. Now, this totally could be a case of correlation does not equal causation, but it is an interesting and potential framework. Regardless, one thing is certain. The long history, track record, and familiarity of gold still makes it the go-to in turbulent times. Most people have not done their 10,000 hours on Bitcoin, and it's showing in more ways than one. Which brings us to Davos. Every year, the World Economic Forum brings together heads of state, central bankers, CEOs, and policymakers at a luxury alpine resort in Switzerland to discuss global finance and governance. This is where all the people who run the current system go to talk about how the system should work. And this week, Bitcoin showed up in the conversation. During a panel discussion, Coinbase CEO Brian Armstrong found himself going back and forth with the French central bank governor on whether Bitcoin poses any real competition to fiat money. And what followed was pretty revealing.
People think about our current financial system as kind of sacrosanct and it's the only way to do it. But if you study the history of money, really it's got created in like 1971 when Nixon went off the gold standard in the US, and we currently have the system where most central banks don't have any link to a hard commodity underneath. I think fiat currencies are going to continue to exist for a long time, but we're also seeing the birth of a new monetary system that I would call the Bitcoin standard instead of the gold standard. And in the crypto space, that is a return to sound money and something that is inflation resistant, because democracies around the world, once we came off the gold standard, are struggling to balance their budget. They're all running deficits, and it's caused inflation in fiat currencies. And so there is a real segment of the population that is looking for a new system based on hard money.
Governor, you have to address this. Is the euro in danger from a Bitcoin standard?
No, I'm a bit skeptical, Brian. Sorry to say it about this idea of the Bitcoin standard. We left the gold standard, but the gold was only a technical mean. What is important is what you say, Bert, that monetary policy and money is part of sovereignty. And we live in democracies, and I think the public role is key. And if we lose that, really you lose a key function of democracy. That said, I always keep repeating that money, as long as it exists for centuries, has been a public-private partnership. You need a public anchor, whatever its form is. Remember, and silver and gold were sovereign assets, so it was on the public side. And then you had banknotes, and you will have CBDC. But anyway, the most important part of payments is in the private sphere, and this is the development of tokenized private money. But this tokenized private money must be regulated to inspire trust, confidence.
It's fascinating that you say that. Brian, you mentioned a complementary role that you could play. Is there a complementary role in Europe when there's so much regulation and it is about the digital euro?
So I think that crypto is very good for fiat currencies. It's very good. Bitcoin is good as a check and balance on deficit spending, because when there is a lack of trust, or people, from like in a U.S. context, if people are worried about inflation, or maybe in places like Argentina or Turkey or Nigeria, they are going to flee to the thing that they believe is going to store value more. So I think in general it's going to be very complementary. And like you said, I think it comes down to trust. And so if fiat currencies can maintain trust and not have, the money printer kind of debasing everybody, then they'll survive. But if countries that have bad behavior on that dimension, Bitcoin doesn't have a money printer. The supply is fixed, and people will go to it in times of uncertainty, kind of like they did with gold.
The guarantee for trust is independence on central bank side. And we have a core mandate, and we are accountable to that. But sorry to say that I trust more independent central banks with a democratic mandate than private issuers of Bitcoin, which have a very useful role. But
Bitcoin is a decentralized protocol. There's actually no issuer of it. So that's in the sense that central banks have independence. Bitcoin is even more independent. There's no country or company or individual who controls it in the world. And so anyway, I think it's a healthy competition, because if people can decide which one they trust more, and I think it's actually the greatest accountability mechanism on deficit spending.
That laugh towards the end was the tell. Complete dismissal and outright mockery. The central banker wasn't laughing because Bitcoin is harmless. He was laughing because he clearly doesn't understand it. History shows that incumbent systems rarely recognize threats early and almost never welcome them. The idea that central banks are more independent than Bitcoin is absurd on its face, and credit where credit's due, Armstrong did a great job correcting him on that. Bitcoin has no issuer, no board, no mandate, no political pressure, no emergency powers, and the mere suggestion that Bitcoin has private issuers reveals a complete misunderstanding of what a decentralized protocol actually is. But the most revealing moment is where he laughs at the idea of Bitcoin being in a healthy competition with fiat money. Because central bankers don't laugh at things that aren't a threat. They laugh at things they haven't yet been forced to take seriously. That's definitely not the behavior of a system that's already won. It's the behavior of one that hasn't felt real pressure yet. And that brings us back to markets. Right now, investors are frozen when it comes to Bitcoin. They're waiting to see whether the traditional 4-year Bitcoin cycle reasserts itself and a 70 to 80% drawdown is still lurking ahead. They're waiting to see whether Bitcoin is a risk-on asset or a safe haven or something else entirely. And that uncertainty is exactly why price has struggled. Which brings us to Cathie Wood's comments on CNBC yesterday.
What do you make of all the volatility in Bitcoin, and where do you think it's going from here?
Yeah, I think that a lot of people maybe do not know much about or understand what happened on October 10th. There was something called a flash crash. It had to do with a software glitch at Binance, and it caused auto deleveraging. And that was a shock that hit the system that has been reverberating as over-leveraged entities are trying to get themselves straight. We think that is playing itself through. In fact, we think it has played its way through. By some estimates, $28 billion of damage in that auto deleveraging cycle. I think we're through that. I know there's a lot of fear about the 4-year cycle. We didn't have much of an upcycle by Bitcoin standards, so we think we're pretty well through the down cycle here. We may test in this 80 to 90,000 range on Bitcoin, but we do think that the test will be successful. It will be the shallowest 4-year cycle decline in Bitcoin's short history. And then we're off again. We think this is 3 revolutions in one: a global monetary system, rules-based, competing against fiat currency, to be sure. It is a technology revolution, and it is the leader of a new asset class, which, surprisingly, and I put it in my New Year's letter, Bitcoin and gold are not correlated with one another. Even though everyone calls Bitcoin digital gold, there's a 0.14 correlation between the two over the last full market cycle.
I guess I would respond to that by suggesting, okay, if I agree with you on that, Bitcoin, or at least gold, is proving itself to be a safe haven asset, I think it's fair to say, whereas Bitcoin, which you suggest is growing in its role as a safe haven asset, doesn't seem to be much of one, considering it's going to be 7 straight down days. And if ever there was going to be a rush to safe haven assets over the last couple of days, wouldn't this be it, where Bitcoin would be getting a boost from concerns over more tariffs in Greenland and upset market? And it's not.
Yeah, if you take from the end of the equity bear market in 22 to today, I put this in the letter as well, gold has appreciated, or it had appreciated at that time, by 165, 170%. Bitcoin had appreciated by 360%. So it had done a lot of work coming out of the bear market as a risk-on asset. We get institutions now moving into Bitcoin, starting with the spot Bitcoin ETFs. And we have a whole new investor who basically is told, as it is being introduced to this new asset class, there's a 4-year cycle out there. And so I think what has happened is we didn't have the big up move around the ETFs that many expected. And we have institutions biding their time, just trying to understand the asset class, trying to understand this 4-year cycle, and trying to understand if they're going to be caught in a 75% down round. We don't think they are, but they certainly are doing their homework, which is great. And we think Bitcoin is both a risk-on asset and ultimately a risk-off asset, especially if you're looking for a hedge against inflation. It's mathematically metered to go up now 0.85% per year, and that's a lower growth rate than gold. But it's also a hedge against deflation, because in periods like 0809, there's not the counterparty risk in Bitcoin, that transparent network that we saw in the banking system back then.
I just love Cathy hitting him with the zoom out. It's easy to look at a chart from 2025 and conclude that gold has destroyed Bitcoin. But zoom out further and a completely different long-term story emerges. Cathy also echoes my thoughts on us being at the tail end of a down cycle in Bitcoin. Now layer this on top of what Bitcoin already did in 2024, and it becomes obvious that we front-ran this entire cycle. We hit new all-time highs before the halving for the first time ever following the ETF approvals. And then we surged to over 100K in December 2024 following the Trump inauguration. That's why the idea that 2025 may have been the bear market for this cycle isn't crazy. In fact, it explains a lot. Long consolidation, heavy distribution from long-term holders, muted upside, and constant frustration. Bitcoin did a lot of work early this cycle, and now gold appears to be front-running the next phase of the monetary transition. That doesn't invalidate Bitcoin, it validates it. Gold expanding the store of value trade makes it easier, not harder, for capital to eventually migrate to Bitcoin. If Bitcoin didn't exist, let's be honest, most of us would be gold bugs. Gold is the on-ramp, but Bitcoin is the destination. I mean, think about it. A shiny rock as a monetary base in the age of the internet is completely illogical. I continue to believe that the longer Bitcoin consolidates while volatility compresses and gold runs, the more powerful the next move becomes. And here's something that still hasn't fully sunk in yet. Bitcoin's volatility in 2025 was lower than Tesla and Nvidia, assets owned by over 60% of Americans. Bitcoin, on the other hand, is only owned by roughly 12%. That's a clear sign of maturation. Lower volatility and deeper liquidity are exactly what's required for larger players, sovereign players, and eventually nation states to move in at scale. Adoption happens gradually until it doesn't. And if your takeaway from all this is that structure now matters more than short-term price moves, that's exactly the right conclusion. This phase of Bitcoin isn't about trading. It's about positioning. For families, businesses, and corporate treasuries thinking in decades, not quarters, strategy matters. And that's where Swan Private comes in. At Swan Private, we work with high net worth families, business owners, and corporate treasuries to design long-term Bitcoin strategies based around accumulation, custody, inheritance planning, and balance sheet integration. No noise, no leverage games, just serious Bitcoin strategy for serious capital. To learn more about Swan Private, visit swan.com/no-second-best. So to wrap up, Bitcoin doesn't need central bankers to believe in it. That part is obvious. It just needs time. Gold is doing its job right now. Bitcoin will do its job next. Being early never feels good in the moment, but it feels obvious in hindsight. So stay humble and stay solvent while the market stays illogical, because the longest consolidations tend to produce the largest repricings. But I'd love to hear from you. Do you think we're already at the tail end of a Bitcoin bear market? And what do you think will be the catalyst to finally move us toward the first true parabolic run in 5 years? Let me know your thoughts in the comments. And if you found value here, like this video, share it with someone, and don't forget to subscribe to the Swan Bitcoin channel so you don't miss the next one. Thanks for watching. I'll catch you next week. And remember, there is no second best money.